Hey, also in this video, I want to cover the performance of my individual retirement account relative to the S&P. And the reason for that is not because I want to show off or anything like that. It's because my biggest pain point in this space is the lack of transparency. If you go out and you try to find a fund or a deal or whatever, most of what you see are financial projections or a prospectus or pro forma, but I haven't found many vendors that share actuals. And I have found no vendors that benchmark actuals relative to common indices. So that's what I want to do for you, to kind of show you my actual performance, how I'm doing in this space to help you make better decisions. So for those of you that don't know, there are many tax protected vessels available to you. So a 401k with an employer, they invest some amount and it's tax protected, whether it's Roth or traditional. You can also open your own individual retirement account with a similar thing. If you're a business owner, you can have a solo 401k. So a lot of the traditional custodians like Fideltiy, Vanguard, Charles Schwab only allow you to invest in a small number of assets. For instance, a targeted retirement account, like 2050 targeted retirement account, or a mutual fund, or some sort of index or something like that. So what I'm talking about here is what's called a self-directed IRA. So if you have an old 401k, i.e. a company you don't work for anymore, or you have a TSP and you don't work for the military anymore, or if you have an individual retirement account, you can roll all those over to a custodian that allows you to open up a self-directed IRA. And then within that SD IRA, you can invest in all sorts of different things, such as real estate, private notes, and things like that. So I did that. It's pretty clear to me back in 2022, we were in an inflationary asset bubble. So that's when I made that transition. So what I'm going to share, I'm just going to dig in through some numbers here today to show you what that looked like for me, because I really want to also cover some key concepts. So I'm going to just share some content here. This might be a little numerically dense, but hopefully you get the comments or the concepts. And then if you have questions, let me know. Okay. So yeah, here it is, guys. So I made the switch back in about March of 2022, and I just invested in a 10% fixed rate fund. So these are really easy to come by. Yeah, I did put on glasses. Yes, sorry. I got a lot of screens and they're hard on my eyes. So, and I've got to read some numbers here. So anyways, a 10% fixed rate fund is really easy to come by. If you're not familiar with sort of private investing opportunities, this may seem high to you, but it's really kind of fairly average. 10 to 12 is pretty average. So I rolled everything over, and this is kind of just one of my old companies, 401ks, and I normalized it a bit. This isn't the exact amount, but so let's just say $80,000. I rolled over back in April of 2022. And then what you're seeing here is this flat line, right? So the way a fund works, the way most funds work, is your equity stays constant. So that $80,000 stays constant. There's no volatility, but you get cash distributions, right? Relative to the S&P, you can see a lot of us think about the S&P is relatively stable, right? Most beta, which is a measure of market volatility, is benchmarked against S&P. You can see here, relative to this fund, there's a lot of volatility in the S&P. The other thing I want to call out with an index fund is that you are not receiving distributions, right? You don't get a dividend. Maybe if you're in like Apple, you'll get a dividend, but with the S&P, this is all equity value. Okay, so I'm not going to cover it in detail on this one, but a key important thing is that ROI, when you're actually receiving dividends, let's say you get 10%, a 10% ROI, but those are in dividends versus 10% equity gain, the dividends are always better. Okay, the reason for that is because cash now is always better than cash later. Okay, so I'll cover that in more detail, but just something to remember. So just look at this. The way a lot of funds work is you receive dividends at some frequency. So for me, it was every 6 months. So after the first 6 months, you can see I received a 5% dividend, right? 10% year over year means I get 5% every 6 months. And then what I did there, you'll see in the next table, I immediately invested in something else, right? So my return is going to end up being more than 10%. That's why dividends cash now is better than cash later, because when I receive that dividend, I can now put that in something else and make more money. So you can see this happen twice, right? I received one dividend, stabilized another 6 months, another dividend invested in something else, and that ended up going up pretty significantly. So the concepts I want to make sure we cover is volatility. So you can see here the S&P index is significantly more volatile than a fund would be. Dividends, which we talked about, where any ROI with dividends is going to be better than the same ROI with just equity. The third one is downside protection. So we see a lot of these things where, the S&P takes a hit and there's a lot of social anxiety and all this stuff. With a fund, you have downside protection, right? Your equity is not going anywhere. You're receiving consistent dividends. And the last one is liquidity. So the only downside to a fund is I was locked into this for a year, right? So I'm unable to exit from this fund. So it is illiquid versus the S&P. If something is publicly traded, you can typically exit out of that whenever you want. So the next thing I want to cover here, this might be a lot, but I want to make sure we cover some of these terms. So we can see basically how the S&P is working over here is, I aggregated this on a monthly basis. The S&P typically changes multiple times on a daily basis, but just for some simplicity, so I could fit it into one slide. So your equity changes every day in the S&P based on what the market is doing, right? So at the start in April of 2022, if I had $80,000, I would have about $75,000 now, right? Meaning the S&P is actually lower than it was, which is why I got out at that time. Now, when we look at the fund, there are just a couple things that I want to cover, a couple key terms. So this column here are distributions. Okay, so that means every 6 months, I get $4,000 on my equity. This is really, really important, especially when I start going over some venture capital things, is this terminology, DPI. These are distributions to paid in capital. This is all that matters. This means the money, the cash that is actually in your pocket relative to the cash that you invested. So the great thing about funds is this is effectively guaranteed. Okay, especially when you start taking a look at venture capital funds, they usually promise a lot, but you usually don't get any distributions until an IPO or an exit or something like that, or even with a syndication. You might end up getting 6 or 7% cash returns in dividends, and the rest happens in 7 years or 5 years when that asset is sold. So this is an important column to pay attention to, where, in a fund, I'm getting $4,000 every month. And then this cash reinvested, what that means, like I said, is I'm not just going to let that cash sit there, right? I bought some things, and I chose to buy Alphabet and Microsoft just because I'm long on those two companies. So anyways, that's what you're seeing here. So you're seeing the cash I reinvested. So that's back out of my account. You're seeing my running cash. So at the end, there's about $1,000 left or whatever. We can see how Alphabet did. So they did pretty good. They started about $3,000 there, and they increased, whatever that is, about 25-30%. Microsoft, I just recently received my second 6-month distribution, bought some Microsoft. But the last thing I wanted to cover here is the undistributed cash that I am owed. Okay, right. So what that means is I'm about 2 months in, 2 or 3 months in to the next distribution, right? So that means there's about $1,300 left that I'm owed that has not been distributed, right? So in a fund, I can be pretty confident I'll get this at some point. But when we start talking about venture capital and some other funds, this TVPI number, you will see some charts where, and this is called the total value to paid in capital. So that is an estimate of how much you're going to get, right? You will see some charts, especially with venture capital, that this number, TVPI, is not correlated with DPI, meaning a lot of funds promise way, way, way more than they're actually able to distribute. So at the end of the day, this 10% fixed rate fund, because of reinvesting, got me about 11% in a down market, right? So I said at 10x the S&P, it actually basically did infinity better than the S&P, because the S&P would have lost me $5,000. So we covered those key concepts: DPI, reinvesting in TVPI. But I just wanted to share this. This is a real example of how a fund works. And really cool things with funds, because you get these distributions at certain intervals, is that if you're interested in something else, you can then reinvest that capital in that other thing. So me, I kind of like, stocks. I do some other things, look at some private companies as well. But this is an overview of how a fund works. Stop share here. So if you have any questions, let me know. And I hope this is valuable for you.